Hello and welcome. You're watching News 9. Top stories from the world of business policy and economy. Adani Group in focus. GQG partners are set to invest almost $1 billion more in Adani Group. And Centre says retailers cannot force customers to share phone numbers and email IDs. Also on the bulletin, Moody's says manufacturing infra are driving India's growth story, has also flagged reform policy barriers. This when FDI inflows are down by 16% in financial year 23. And tainted cough syrups may have killed more than 60 children in Gambia last year, a panel report has said. We will look at the details emerging from that report. And also on this bulletin, fake image of explosion in Pentagon has gone viral, created chaos in stock market. A first such instance where AI-generated image has in fact led to chaos and panic in the markets. All that and more in this bulletin. With me in the studio, my colleague Karthik Malhotra. Also joining us, Rakesh Garg. Karthik, coming to you first. Big stories coming in there from Adani Group. Adani Group remains in focus not just for its stock performance, but also for the fact that GQG partners are now saying they are going to invest up to 10% in Adani Group.
It's all correlated, right, Shweta? So, good morning to you too. It's correlated. Why is GQG suddenly interested in investing even more, upping the stake by 10%, and some reports also suggest about $1 billion worth of investment, simply because it has seen a bumper return on the $2 billion investment it made in the month of March. And remember, Jan end is when the Hindenburg research had come out, and it had sort of tainted the Adani Group's image globally, and the stocks had taken a beating. Of course, the MCIS delisting of the Adani stocks also happened globally, etc. But all that notwithstanding, the fact is, with the report that came out from the Supreme Court panel on Friday, the 19th, and this sudden surge in the Adani stocks that we saw on Monday as well as Tuesday, and the rally many analysts are suggesting is likely to continue even today and for the foreseeable future. Though when I just checked, there was a little dip in Adani stocks overall today. Adani Enterprises, of course, not climbing as rapidly as it did yesterday. In fact, there was a slight dip. But Rajiv Jain, the CIO of GQG, and investors in general have seen the kind of returns that the stock has given. And of course, Rajiv Jain has also gone on record to state that Adani Group has got perhaps among the best assets available in India, by assets as in the physical assets, the infrastructure that the company has built. So no surprise there. I think there is going to be a lot more investment that we see, not just at a retail participation level, but even into institutionally, there are going to be more investors flocking in, given the return it has seen, and which some quarters in the media reported the clean chit apparently that the Supreme Court panel has given Adani Group. Though to our finding, there wasn't a real technical clean chit per se. But I think all these things play well on the market.
Has affected the market sentiments.
It has impacted positively the market sentiment.
Rakesh joining us at this point in time. Rakesh, good morning to you. Rajiv Jain betting big on Adani Group. In fact, reports suggest that as of today, 3 months into his investment, which has surged massively, he has gained almost 9,000 crore for betting on Adani Group. So big returns there for Rajiv Jain.
Good morning, Shweta and Karthik. As I've been saying right through the beginning, there are two ways of looking at the Adani story. One is that, one part of the probe has come into manifestation, which is the Supreme Court appointed panel, which to our mind has neither damned Adani nor given it a clean chit. And whatever we may say in the media commentary, the stock market and the entire ecosystem, the financial ecosystem, has a way of looking at that report. And it looks like that, they do see, the report as not a negative for Adani, if not a positive for it. So that's the probe part. And we are also awaiting the SEBI findings, which will come in August end. But the other part of the Adani story is, what is the business case? Adani presents, as Karthik rightly mentioned, a very strong fundamental business case. It has a set of diverse, assets which have economic value, and it is basis that business case that actually, GQI and Rajiv Jains of the world are looking at investing in this particular company. And if one is able to profile Rajiv Jain, he was one of the few people who invested faith in Adani at a time when actually everybody was so to say, putting a question mark on the company. But even then and even now, yesterday's interview that he gave to Bloomberg talks about his faith in the asset class that Adani represents in terms of his order book, in terms of the holdings he has. The key focus remains for GQI and Rajiv Jain, the infrastructure sector, which even the Moody's has identified as the key growth area for India. So in that sense, one is looking at nothing being out of sync. Adani represents a key infrastructure foray, and it has potential, and GQI sees value in that. And that trust has been, so to say, has been confirmed, in fact, more than confirmed by the returns that you just now mentioned. For about $2 billion, there's $3.5 billion value today. And I was looking at the GQI website in the morning, and its core philosophy, it's an asset management fund, and it has about $94 billion dollars in AUM right now globally. And what it talks about is looking at emerging markets and markets in need of investments, but having potential where it invests through a clutch of investors that are, so to say, aligned with GQI. And the proof is here, and the returns are there for the investors. But on a note of caution, GQI and Rajiv Jain, who has a wealth of experience investing, this particular company was set up, I think, in 2019 under his chairmanship. He's also the chief investment officer. There have been some missteps, so we're not saying that, what he does with Adani or GQI investment in Adani will follow the trajectory. But looking at the track record of GQI, one is able to conclude that there have been some missteps, including, his overweight, his being overweight on Russia this was before the Ukraine war. So the company had to scale down, and him being underweight on China, where actually now, contrary to reports, there has been a, growth recovery. So in that sense, GQI, Rajiv Jain, Adani, and the India story present a certain context. Also, we must point out, happily and merrily for India, there were a lot of naysayers who actually predicted that the stock market will observe a huge crash post the Hindenburg report. That fear has also not come true, partly because, as we said, the Indian stock market is not just resting on one particular company or one particular sector. The growth is manifesting in several sectors that have shown a huge trajectory, from banking to finance to infrastructure to pharma. So in that sense, we must put all those speculations to rest that in the stock market is not standing on its firm feet.
Okay.
And that also goes about the company Adani. I think it has a strong business case. Yes, the probe must come to a logical conclusion and must be transparent, credible for everyone to believe that India has a robust regulatory framework.
And while we are on the subject of Adani, there's also a tour that Gautam Adani has organized for bankers and financiers from India. And apparently they are being taken around the ports and the airport and the other roadways infrastructure that Adani has built. I think in a bid, again, not to just shore up investments, but also leverage loans that Adani may want to take to further the cause of its growth. So that is also underway. I think just the might of the network, the showcasing of the infrastructure which has been built by the company. So that tour is also on right now, and is likely confidence building exercise, and that's likely to happen. My fear with all this excitement is that what if the SEBI report, which comes out on the 14th of August, if it does, at least some progress on the report expected to come out on the 14th of August, will it really be able to, given all the noise around the Adani group and given all the bullish sentiments that we are seeing right now, will it really be able to do an objective investigation, tide over the opaque structures, peer through them literally, and be able to come out with something concrete one way or another? I think the last thing that we would want for any investment to happen at a retail level or at an institutional level is an eyewash of a report, right? We don't want any fog in the report. We need to see some progress one way or another. And I think that should very objectively state whether or not there was any truth to the Hindenburg findings on short selling, and whether any norms on MPS were flouted at all or not. Okay. So I think that is something that we should all be looking out for very closely. And until then, of course, the rally is likely to continue. The company will keep getting investments. That seems to be the case. That seems to be the build-up, at least, to the case right now. And banks, after the Supreme Court panel report has come out, will be a little more open in lending to the Adani Group. But I think it's important to for SEBI to sort of reassert its position as a market regulator and come out with a clearly worded, clearly drafted report, leaving no ambiguity, so that Indian retail investors, global investors and bankers and the whole market and the economy as a whole get a semblance of what really went into the damning report that came out on 26th of January.
Fair concerns, Karthik. And I want to bring in Rakesh at this point in time. We're of course waiting for that report, Rakesh, that is going to finally shed some light on whether the allegations of short selling were true or not. But from our reading of the expert committee report, we understand so far SEBI has hit a roadblock on various counts on public shareholding, on whether the allegations of short selling or the 13 FPIs that invested in the Adani Group, what was their structure like, who the last beneficiary was, all of these important parameters that the expert committee looked into. It said in its report that although there is no instance of price manipulation, on everything else SEBI has hit a roadblock. The momentum that we are seeing around giving Adani Group a clean sheet, do you think that could cast some shadow of doubt into the functioning of SEBI? Because there's so much jubilance in the market at this point.
I think there are two different things. See, SEBI has a reputation to defend, and Indian regulatory system has its reputation to defend. If you go by the track record of regulatory framework in India, right from Harshad Mehta probe to Ketan Parekh probe, there have been independent probes which have stood the test of time and scrutiny of facts. So in that sense, I think let's not prejudge the SEBI report. And the expert panel report says it is not able to conclude that there is a regulatory framework problem. So let's not also overstate and overread into what the the Supreme Court appointed panel has said. Yes, at bullet point 52 or 53, as I was looking at the executive summary, it does make a very, very strong statement on the overall functioning of SEBI. While it advises SEBI not to filter its energy in smaller cases and make a test case of focusing on a big ticket, complex study, and I think without naming Adani, they are giving a reference to SEBI that you must, so to say, come clean on the probe and make your recommendations. So I don't think we need to unduly worry about Indian regulatory framework not being concerned about maintaining and in fact raising the reputation level. And as we've been saying on our shows, there are two parts to the story. One is that if there is a wrongdoing, it must be put in public light and there must be a penalty for that. Independent of that, what is the company doing? We said that it is raising investments. It is also, post the Hindenburg, has done some intelligent what we call financial re-engineering in terms of leveraging its debt, as Karthik mentioned. It is paring down its expansion in some ways, and it is also looking at creating greater confidence. And stock market is very unkind, as we know, Shweta and Karthik. It reads much more than journalists and commentators read. It has it has its own way of judging the situation. And let's also note that Adani's ports is back to pre-Hindenburg levels. And the trajectory that Adani stocks have shown, even before the Supreme Court panel report, as the report mentions, is that there is a healthy trajectory where it is recovering logically on a certain path. That doesn't, exonerate either SEBI or Adani from being under the needle of the suspicion until the final report comes. But let's not prejudge SEBI. So that's
all right. Fair enough. On the market's judgment, market is sort of giving its judgment over the last 3 days. Adani Group's market capital has surged over 1,78,000 crore in 3 sessions, hitting almost 10.7 lakh crore.
Upper circuit on Monday, about 13. Adani Enterprises up 13% on Tuesday.
Stocks have rallied 13%.
That's right. But strangely today, right now as we speak, 10:28 a.m. on the NSE block, you have Adani Enterprises incidentally down 1.5%. And you've got Adani Ports also down about 0.97, almost 1% down. And this despite the GQG investment which the market should have seen more kindly. I think we'll have to really understand what is the market reading into Adani Enterprises and Adani Ports at this moment. Maybe it's just profit booking of yesterday. You saw the stock surge, like you just mentioned, a 13% rally in Adani Enterprises. So maybe this morning pairing of losses or booking of profits is what is happening.
Okay. Would you agree with that, Rakesh? Or is there a development that we're missing?
No, I'm saying you can't sustain a 13 or a 19% growth on the stock market. Even the best company, best managed company wouldn't be able to sustain that. In fact, the rally hit a circuit breaker. So obviously it has to hit a, it may not be easy for Adani to have a, a $147 billion recovery, which it lost post Hindenburg. My own view about the Adani stocks is that, I don't have evidence to prove it, but that's an assessment that I've made looking at markets. If, the pre-Hindenburg estimation of Adani's was obviously an overstatement. It didn't reflect in the actual case study or the business model of the company. And then the post-Hindenburg, so to say, hammering, that also did not truly reflect the business case. So from an overestimation to an underestimation, there is a realistic estimation. I think that the stock market will find when it is assessing Adani stocks.
Okay, a fair estimation of Adani stocks. Hopefully, a fair estimation will come through the day today. We will, of course, keep tracking all developments coming in from Adani Group. But shifting focus to another important story that we are tracking, and that is the centre has now asked retailers not to ask for phone numbers and email IDs when issuing receipts to people. And I think all of us struggle with that, Karthik. Every time you go and buy something, the first thing they need you to do is give your phone number away. And that is a larger problem because that phone number doesn't really stay with them. In addition to being bombed by spam messages and calls, we now know, and there is proof, ample proof out there that these numbers are easily available in the market to or every person who wants to sell you that credit card, give you that loan. And so I think it's a good move all in all.
Or do a cyber crime on you or fraud you of your savings.
Absolutely,
true.
track you for a cyber crime.
I think this was long coming, and I think the statement should have been released much earlier as we saw the boom in telecom and overall the proliferation of internet usage. But yeah, what do retailers really ask this number and this email ID of yours for? Eventually, everybody wants to build a loyal customer base, and I think marketers are very cognizant of the fact that you need to know who your customer is, so you can customize offers for them, you can communicate those offers to them, you can interact with them, and that obviously borders spamming in a lot of cases. So, so I think it's good that there is no compulsion on sharing phone number or sharing email IDs. But I think marketers are also fairly smart. They will want to still get in touch with you, and they will want to understand who you are and what your number is, what your email ID is, so they can reach out to you whenever required. They have a new offer, they have a new scheme. They want to just reach out to you for any new launches, anything else. I think it should be an option. Like, on an average, anytime I go to a store to purchase, let's say, a book or even a piece of clothing, there is you still as a consumer have a right to tell the cashier that I'm not comfortable sharing my phone number, and they're okay with it. The only challenge it runs into is that you cannot come and exchange or return the product, because it's difficult for them to identify in the absence of a phone number whether you are the same customer who came and made that purchase or not.
And because there's now also an endeavor to go paperless,
yeah,
a lot of these retailers ask for your phone number so that they can send you the receipt online as opposed to handing it over to you physically.
That's right.
And that is going to be a problem as well.
That's right. No, but I think, technology also has its ways. There could be technologies like Bluetooth or near field communication or something installed through which there could be a transfer of your receipt on your phone. But yeah, I mean, can you prevent, let's say, airlines from asking you for your phone number or email ID? You can't. Can you permit hotels to not take your to not take your phone number, your email ID? I mean, how do they give the reservation confirmation details back to you? So so I think it'll have to be looked at from multiple prisms, multiple perspectives, and it needs to be a level playing field at the end of the day. It cannot be restricted only to retailers operating, small shops or big stores in malls, etc. But airlines, hotel industry, banking, all of them obviously need your contact details, contact information, banking, etc., even for KYC, but hotels also, because they have your Aadhaar card, which is also technically not mandatory. You can refuse sharing your Aadhaar number or a photocopy. But these are practices which we are aware of. I think what the government should instead insist on, and this is where technologies like blockchain can come in, this is where other solutions by private organizations can come in, that the objective has to be spam reduction. The objective, and this is where DOT needs to come in and play a larger role, and the objective needs to be data protection. Right. If these two can be handled with retailers still able to seek details from customers, I think we have a winning proposition. But I think a blanket refusal is not going to do good to the way AI, machine learning, learning algorithms try to make sense of your tastes, your preferences, recommend products to you, and customize deals which can then be communicated to you. So I think it has to be a much broader ambit rather than just a blanket ban on certain retailers, certain stores, etc.
Okay. Now we are given to understand that an advisory that has been prepared by Department of Consumer Affairs will be shared publicly for retailers to also understand what they can and cannot ask, and in case customer says no, there is absolutely no obligation for a retailer or for a customer to share their details, for a retailer to ask for those details. Those would be interesting details to watch out for. But another interesting story we're tracking, and moving on to Moody's now, that says that manufacturing and infrastructure are going to be drivers of growth, Rakesh, for India.
Well, I mean, that's as per the script. It's not out of syllabus. We all know that India has really built massive infrastructure in the last few years, especially in the last 9 years. The pace has been phenomenal. It was the requirement of the day. But before I expand on the infrastructure piece, I think it's important to look at the story that you were just mentioning on the retailers' intervention. As Karthik rightly pointed out, there are two parts to it. One is the DOT, the Telecom Ministry, or the Ministry of IT Communications. Because, we do know, despite Digital India being celebrated at various quarters, the DND, a very basic function, has been a failure. We've not been able to enforce that. And, so a blanket ban on retailers not asking for a mobile phone is not advisable for two reasons. Data is a virtue if it's used well. It becomes a vice if it's not used well. It becomes a vice when there are ethical issues and enforcement issues. If, any sundry clerk at a retailer or a cashier, uses the data without any supervision and sends it and sells it, actually, it becomes a problem. That doesn't mean that data is not relevant to retailers or to the overall enforcement system. So, misuse has to be prevented. For that, Karthik rightly mentioned the Department of Telecommunication has to become has to have more teeth. And second is that retailers need a lot of cash transactions happen. We've been on the 2,000 rupee story, and we've seen that a lot of cash transactions are happening without a mobile phone. It's very difficult to link it to an individual who's using cash and making big ticket purchases. Second, there are discounts, there are loyalty programs, which are part of genuine, healthy marketing campaigns for any brand or for any consumption story. And India's consumption story is now fabled. In that sense, you can't take away those marketing initiatives from a retailer. And lastly, e-invoicing is happening in a big way. It's paperless, but e-invoicing, e-reports of whatever you do is phenomenal. I mean, you go to Dr. Lal Path Lab. I went some time back for a regular routine checkup, and there's no receipt now. Receipt comes on your phone. So if you divorce the mobile number from the transaction that you're doing, it's going to be very difficult, and you can't be selective. I completely agree with Karthik. You can't ask hoteliers to to ask for Aadhaar card, and then some hotels ask for double identity proof. And here you don't even give the telephone number. Yeah,
absolutely. In fact, I went shopping this weekend, and my receipt came on my mobile phone, which essentially brings me to that very important point of how do you work around this? I mean, you want to go paperless on one hand, Rakesh. On the other hand, you can't block retailers from getting your mobile numbers.
I mean, it's a failure, complete failure of, despite Digital India, the Ministry of, the relevant ministry has failed to enforce misuse of data, number one. And, at a moral and societal level, we need to be a little more cognizant of sharing that number with someone for some 100 rupees or 200 rupees. I mean, for my housing society, I don't know how many times that housing society directory has been sold, resold, for whatever little transaction. So I think there are societal issues, there are ethical issues, and there is an enforcement issue. And I do repeat, at the cost of sounding a little negative, that we failed to bring about, despite all the checks and balances, you get all kind of spam calls. They're always one step ahead of the curve.
True.
Coming back to the infrastructure story, I think, the good news about infrastructure is that, while it has been one of the key mainstays of this particular government, it will continue to be so the case for the next 1 year, which is critical year before we go to elections. So I don't see any letting down of the fervent push for infrastructure sector. And there are many projects which are on the, like linking Delhi, Dehradun in 2 hours, Delhi, Jaipur, 2 hours, which is closer home, so I can talk about it, but it's happening across big metros being connected to smaller towns, highways being built. There is a charge here that, the infrastructure development in India, especially the roads and highways, is little elitist. So, there are independent studies by think tanks which point out that if you go to a small village, India has 6.5 lakh villages, there is not much improvement there in the last 9 years. But when it comes to connecting highways with smaller towns, tier 2, tier 3, tier 4 towns, there has been a growth. But so momentum will sustain. So Moody's is right, and the whole world is talking about infra and the digital stack as India's two growth stories. Talking about reforms, we all have been lamenting the lack of reforms in this particular episode for the last few years. In the second term, what was expected in Modi's government, that there would be a massive buck up on reforms. Unfortunately, to my mind, I may be in a contrarian point of view. We went back on the agri reforms, which should have set up a huge facelift to the Indian economy. I'm not saying we need to be anti-farmer to do that. We need to be pro-farmer to bring about farmer reforms. We can get into the labyrinth of that in a subsequent show. But rollback of farm reforms is, really unsettling, and shows that this government, despite having the huge majority, is weak-kneed when it comes to reforms. And the reforms that Moody's is talking about are about opening up business, setting up businesses. I do remember, having looked at business for the last 3 decades, this perpetual complaint by global investors about this single window being tom-tommed by each state government, and this very competitive investment shows and road shows happening in India and abroad. Even Mamata Banerjee going to Hong Kong, to US and UK, saying that please come to my state. But when it comes down to the micro, when the guy steps in, he gets the clearances, he needs the electricity connection at the plant, there are huge challenges still there. So the gap between the macro and the micro,
right,
which is extremely relevant to business, needs to be bridged.
Okay, and Rakesh, we are getting feed of RBI Governor Shaktikanta Das speaking at a CII event. We'll cut to that.
Inflation softening, so it's all there. So it's not a decision which is entirely in my hands, because I am driven by what's happening at the ground level. So to that extent, I think I will leave it at that. And I have also on a more serious note, I have said that please don't read it as a pause. It's a pivot, and I will talk about it a little later. So what I have done today is that I would like to highlight on 4 aspects broadly. I would like to first touch on the global backdrop which is prevailing today. Then I will talk about the domestic growth scenario. Sanjeev has already touched upon it quite a bit. I'll talk about the inflation and our approach. Then I will also generally talk about the policy approach of the Reserve Bank of India, because Reserve Bank of India, as you know, is not just a monetary authority. It has got multifarious responsibilities as a banking sector regulator, as a financial sector regulator, as a payment and settlement system regulator, and a host of other functions. So let me first start with the global backdrop. As all of you are aware, and as all of us are aware, the global economy is facing headwinds from the lingering geopolitical conflict, elevated inflationary pressures from across countries, and tighter financial conditions on the back of monetary policy tightening by major central banks across the world. The IMF's World Economic Outlook of April 2023 projects global growth to decelerate from 3.4% in 2022 to 2.8% in 23, before rising again to 3% in 2024. The economic slowdown is, however, concentrated in advanced economies, with Asia-Pacific region expected to contribute about 70% of global growth in 2023. And according to the same estimates, India will contribute about 15% to global growth in the current year. Financial markets remain volatile as uncertainty over future monetary policy path is keeping market sentiments on the edge. New Zealand has earlier today increased its rates by 25 basis points. Food and energy insecurity and risks of debt distress pose downside risks to outlook for emerging market and developing economies, that is EMDEs. According to IMF, 39 low-income developing countries are in debt distress or at the risk of debt distress. On the upside, global growth is being supported by the easing of supply chain disruptions, gradual normalization of energy and food markets, easing commodity prices, and reopening of the Chinese economy. Global inflationary pressures are also showing signs of abatement, although they remain well above the target in most of the countries. Central banks across the world have continued to tighten monetary policy, though at a much slower pace relative to the aggressive 75 basis points rate hikes which we witnessed in 2022, while some central banks have even taken a pause in their recent meetings. We have a case of Canada which took a pause and then again went for an increase. So therefore, global monetary policy is still settling down because the inflationary conditions are fast evolving. And all central banks are watching it with what I call an Arjuna's eye, or what others call a hawk's eye. As central banks raise interest rates rapidly to contain inflation, fault lines emerged in banks and non-bank financial intermediaries. The resilience of the global financial system has been severely tested in the recent times, following the banking sector turmoil in the United States and in Switzerland. Naturally, it resulted in financial stability concerns, not only in those countries, but all around. Quite naturally, the outlook has been adversely impacted, particularly in the advanced economies. The proximate cause of this banking turmoil in the United States and Switzerland in March 2023 is a confluence of rising interest rates, unrealized losses in debt securities portfolio, and other idiosyncratic risks. Coexistence of high inflation and banking stress is complicating the responses of central banks as they face a trade-off between the risk of either straining financial markets or having to tolerate longer periods of high inflation. Amidst these global uncertainties, the Indian banking system remains stable and resilient, with strong capital and liquidity positions, improving asset quality, better provisioning coverage, and improved profitability. Let me now turn to the domestic growth scenario. Sanjeev has already touched upon it, as I said. For the current year, for the year that has just ended, that is 22-23, the estimates are that it will be 7%. But there is a possibility that it could be even more. The data will come at the end of this month. According to all the recent trends, it will not be a surprise if the GDP growth of last year comes slightly above 7%. But let's stick to 7% for the time being. And the trends, the fourth quarter trends in particular, it initially appeared in the third quarter that there was a pent-up demand which was supporting economic activity. But all the economic indicators in the Q4 of last financial year, they show that economic activity sustained momentum, and in fact, all the fast move, high frequency indicators, about 70 of them which we monitor in the Reserve Bank of India, almost in all of these high frequency indicators, the momentum was maintained in Q4. So therefore, I will not be surprised, we should not be surprised if the growth is slightly more than 7%. For 23-24, we have given a figure of 6.5%. And we have said that, with lot of, we have done our internal analysis. Of course, the IMF and other international institutions have given lower projections. For instance, the IMF projects it at 5.9%. But we derive confidence at this point of time from the fact that agriculture has done well, and we are assuming a normal monsoon. Services sector continues to perform very well. In fact, as you all know, although merchandise exports slowed down, moderated last year and have moderated, it is the services exports which have really gained further momentum. So agriculture has done well. Services sector on the whole is doing well. The capex and the infra spending by the government has also picked up with, again, large provisions in the budget for capital expenditure by the government. There is evidence of revival of private investment also. We notice it in certain sectors, particularly steel and cement. Your members of CII will know better. Capacity utilization in the manufacturing sector, according to RBI's latest survey, which we have published, is around 75%. But I am told that the CII survey shows that capacity utilization in manufacturing sector is even higher. I don't know whether they have shared the number with you, so I'm not mentioning it, but in our interaction last week in Mumbai, I was told that, I have the number, and it is clearly much more than 75%. So capacity utilization in the manufacturing sector continues to be robust. Credit offtake in banks also is remaining quite resilient. It's about 15.5% credit growth according to the latest data. Over the last 1 year, we see credit offtake. The banking sector credit, I'm talking about bank credit, the growth is about 15.5 to 16%. The latest number I have is 15.5%. So therefore, these are the, these are the upsides to domestic growth, and that gives us the confidence that, India should be able to record a growth close to 6.5%. However, there are downside risks which are commonly, which is known to all of us. Geopolitical uncertainties, any surprises on the geopolitical front, and the drag from merchandise exports because world trade seems to be contracting. So these are the downside risks. And of course, on the agricultural front, there is this forecast of a El Nino, and we have to see whether it actually happens or how, if it happens, how intense it is. And there is talk by the IMD about the Indian Ocean Dipole. I am not an expert, but the IMD says that there is evidence of positive Indian Ocean Dipole, which to some extent should be able to neutralize the impact of El Nino. But let us leave that to weather experts. But this is an uncertainty which only time will tell to what extent it affects our economy. On top of this, all these factors which I mentioned, we have macroeconomic stability. Now, on the back of macroeconomic stability and the robust financial sector stability that we have, I think there is a platform for supporting domestic growth. Macroeconomic stability in the sense that inflation has moderated. The last print, is 4.7. Perhaps the next print is could be lower. GDP growth, I have just mentioned, that is sustained. Current account deficit, which was earlier feared that it will touch 4%, 3.5%, we have given out the numbers. They look very much, and in the last year it was eminently manageable, as I have said. We were helped by the fact that we are now witnessing record, remittances from abroad. The fiscal deficit of the government is also on a consolidation path. So on the back of macroeconomic stability and a robust financial sector, I will touch upon the financial sector a little later, but on the financial sector, particularly our banking sector today, the percentage of non-performing assets, according to the last December 2022 number we gave, the GNPA, that is gross non-performing assets of the banking sector at the systemic level, was 4.4%. We have the unaudited figures for the period ending March 23. They are even lower, but I would not like to mention the number because they are unaudited, and we would rather wait for the audited figures to come in. So the non-performing asset, which was a huge challenge for the Indian banking sector, has come down, has been moderated, and it is showing very good signs of its resilience. And on top of that, we have the advantage of demography, which again is a huge opportunity for India, and it's something, I think, which will eventually add to our potential output, or what some people prefer to call it as India's, growth potential. But let us call it potential output. So therefore, that's a thing which will play out in the medium to long term. There is one aspect which I must mention in a forum like this. It is with regard to access to technology and investment in technology. We are living in a highly fragmented world. Access to technology, availability of technology in a seamless manner has become a challenge. In this matter, the world is no more flat. Technology is now has become difficult to access. There are barriers, there are restrictions to get technology, and it's not flowing freely across boundaries. So therefore, while, I think it's for the industry also, apart from, the various other authorities, I think it's for the industry to play a primary role and to have access, to work out access to that technology. And what's even more important, I think as a country we need to invest more in technology, because the future belongs to technology, and unless we have technology, we will not be able to sustain our progress. But I am quite optimistic that this is an area where the public and the private authorities, the public and the private sector associations like the CII and the authorities in the government will be able to work together, and this challenge will be converted into an opportunity. But domestic investment in technology has to grow, and private sector has a big role in it. India demonstrated that in the context of COVID, when the vaccines were produced within the country, and a population of 1.4 billion was vaccinated in India, perhaps the highest vaccination that was done world over. And I think we have the capacity, we have the potential, but this is something which I would particularly in a forum through the CII, I would like to appeal to the members of CII to focus on this aspect, because this is something which India needs to sustain its growth. The third aspect I wish to talk about is with regard to inflation. Now, inflation has moderated, but there is no room for complacency. Let me just touch upon our, the inflation path that we went through, the challenges that we went through over the last 1 year. In February last year, the outlook was very benign. We assumed that inflation will come out. Inflation will sort of moderate. But then we had the big surprise from the Ukraine war. Nobody expected the Ukraine war to sort of really happen, and to sort of with such intensity. And naturally, it had impact on prices of food grains, on edible oil, on cereals, on across the board. The commodity prices shot up. The crude oil, which is again a primary, India being a huge importer of crude, all prices went up, and naturally India was impacted. Now, when the war came as a surprise, naturally, as a central bank, we cannot say that we will not give any surprises. I mean, we had to also, therefore, do a surprise meeting last year. Many of you, that time it looked, in fact, we faced quite a bit of criticism. But what the market missed out at that stage is that in April itself, we had given some early signals of our impending action. We had changed our priority to inflation over growth, and we had given some indications saying that the Reserve Bank is monitoring the situation closely and will not hesitate to act if the situation so warrants. So we took that surprise, we did that surprise meeting. One point which I want to mention here, nobody likes to give surprises, but when sometimes the situation itself gives you surprises and overtakes you, a situation like when the war happens, which was not expected by anyone, naturally, I mean, things are, different. So therefore, we had to have that surprise meeting of the MPC. I'm not trying to be defensive about it, because subsequent developments have proved that the decision of the Monetary Policy Committee to meet, to hold a surprise meeting and to start the cycle of rate increase was the right decision. And I think that has been now accepted and recognized all around. Again, last MPC, we gave you a positive surprise by taking a pause. I think the whole market was expecting that the Reserve Bank perhaps will take the Reserve Bank will perhaps increase by 25 basis points. But we gave a positive surprise because our assessment was that we have done 250 basis points rate increase. Let's now allow that impact to play out. Increase in rates, monetary policy acts with a time lag, and you have to allow that time for the monetary policy to play out and to transmit. We monitor the monetary policy transmission both in the credit side as well as both in the interest rate side so far as credit is concerned, the market interest rates are concerned, the overnight rates of money markets. So far as that is concerned, we also monitor the transmission in the liability side, namely in the deposit side. So therefore, the situation is extremely fluid, the situation is highly dynamic, and I would just like to say that the war on inflation is not over. We have to remain alert. There is no cause for complacency. Especially we'll have to see how the El Nino factor, what has been anticipated, the El Nino, how it plays out. The third aspect which I would like to mention is with regard to, I think that is the fourth aspect which I would like to mention, is with regard to the policy approach of the Reserve Bank. Now, our endeavor, especially over the last 3 to 4 years, when we have been confronted, like the rest of the world, we have been confronted with huge uncertainties. We have been confronted with black swan events, one after the other. The COVID, followed by the war, followed by the synchronized monetary policy tightening, the fragmentation of global trade, the fragmentation of supply chain, and host of other challenges have, the sudden increase of commodities.